welcome everyone to our October edition of West Side Meetup. Once again, thank you everyone for joining us on this last Wednesday of the month, as we have this meeting every last Wednesday, right, of the month. So just want to go over some housekeeping rules before we get started here, right? So first, this meeting will be recorded and posted online if you wanted to watch it again, if you missed something or want to share it with some friends. Secondly, I'd like to ask everyone to please mute your mics to minimize distractions for our speaker and for everyone else. Third, if you have any questions, please post them in the chat and we'll answer them during the Q&A portion of the presentation. And lastly, please stick around after the presentation as we go into breakout rooms to do some networking, right? And always a disclaimer, everything that's presented in here tonight will be for information only. And, and one simple fee that I ask each and every one of you is, if you find any value tonight, please let your friends or family members know about us and our monthly meetup here on West Side Meetup. Now I'd like to go ahead and share a little bit about myself. So for those of you who don't know who I am, my name is Gilbert Coloma. I am an out-of-state investor, growing my portfolio all while working a W-2 job, right? Growing my portfolio to, increase that passive income to hopefully retire sooner rather than later. I am also a WNN advisor where we coach and consult, anyone that's wanting to get into real estate investing out of state. So that's a little bit about me. Thanks again, everyone, for joining us. I'd like to, move it on to Brandon Robbie here.
Right on. Yeah, thank you, Gil, for that. Hey, everybody. Thank you, folks, for coming on tonight at a different time. So we appreciate you guys being flexible with us. If Gil did not mention, we do have a roster tonight that, in case you're not able to connect with everybody in the breakout rooms, you can go ahead and fill out that roster. It has spaces in there where you can fill in your contact information, what you need right now, and also what you are good at. We're all about adding value here, right? So go ahead and fill out that roster when you have a chance. Also, I want to invite you guys to join our Facebook group, West Side Meetup, and go and follow or subscribe to our YouTube channel. And the links are right there in the chat. If you are not already on our email list, you can go ahead and send us an email. It can be really short. Hey, I want to get on your email list. Please add me. You can go ahead and send it to westsiderealestatemeetup@gmail.com. All righty. So if you guys don't know who I am, my name is Brandon Robbie. I'm an active investor and WNN advisor, just like Gilbert. And I'm also the co-host of not just this meetup, but also the in-person meetup with Gilbert, Real Estate at the Park. And, I'm excited for tonight's topic and for tonight's guest. I had the pleasure of meeting our guest a little while ago, and, he gave me the opportunity to be on his podcast to ask my questions to seasoned investors. So now I get to ask him some questions from myself and then from you folks that have submitted questions earlier. But, I'm looking forward to it. I'm looking forward to our conversation. And don't forget to stick around later as we go into our investor spotlight and then, of course, our breakout rooms. All righty. So tonight I get to, or we all get to hear from this seasoned investor. His name is Brian Briscoe. He's going to share a bit about himself and his background, but I'm just going to give you guys the quick rundown. So Brian is a full-time apartment investor with ownership interests in over 50 million in assets. He is also the director of the Multifamily Educational Community, the Tribe of Titans, and the host of the Diary of an Apartment Investor podcast. He recently retired from the U.S. Marines after 20 years of service. So thank you for your service as well, Brian. Thank you for that.
Thanks, Brandon. Appreciate it.
All righty. So welcome, Brian, to West Side Meetup. By the way, guys, he is it's late on his end, so we really appreciate him choosing to spend his time with us. I believe he shared that it's about 10 in the evening. So Thank you for that, Brian.
Well, I've always been a night owl. So when you pitched me when you told me what time it was, I'm like, yeah, I can do that. I'm almost always up at this time. So, not a big deal. I will say I'm usually walking into the gym between 9:30 and 10, and then, in bed in another hour and a half. So, yeah, it's not that big of a deal, but thank you.
Oh, right on, right on. Cool.
Yeah.
So, if you could just start off with sharing a bit about yourself, how you get started in multifamily, and
Yep.
your journey to
Yeah,
where you are now.
Yeah. So I think to talk about how I got started in multifamily, I got to talk about how I got started in single family. So almost 20 years ago, God, it's been that long. I decided to go active duty right after September 11th. And at my first duty station, started hearing some buzz from the other people around about this book, Rich Dad, Poor Dad. I had no idea what it was, and I picked it up. And if you guys have read the book or read it recently, Robert Kiyosaki talks a lot about syndications, and he talks a lot about multifamily. Okay. Now, I don't think he ever uses the word syndication in there, but having just recently reread the book, it's very clear that's what he's talking about. Private placements. He uses that word. But when I started reading that, and I remember thinking how intriguing, commercial real estate was, and apartments and everything else. But, I had this big, gigantic wall right in front of me. It's like, I don't even know where to start. I can't do that. I mean, my dad's a mailman. There's only one piece of property he's ever, well, two. He had two houses that he's ever owned, and he wasn't investing. Didn't have anything but a pension plan for his retirement. And so I didn't know any better. And so I started thinking about, well, if I can't do apartments, if I can't do that commercial real estate thing, what can I do? And I sat down, I thought, you know what, I can figure out how to buy a single family home. Most people in their lifetimes figure out how to buy a single family home. And I took advantage of the fact that I was military and that I moved every 2 to 3 years to start buying single family houses. And what I did, like I said, at the time, it was as big as I could think. And it was buy a house or try to buy a house every time I moved. And what I realized after several years is I had a handful of properties, and you never got too many of them. But in my life, I've owned 4 single family. But the idea, I did see that it was valuable. I saw that the rents kept on going up, and my mortgage balance kept on going down. And I saw price kept on going up, or the value of the homes kept on going up. But what I realized is my model was not sustainable. Living in a place for a year or two, then moving out and rinse and repeating, that model meant that at most I could buy something, once a year. That's as quick as lenders will typically turn around and give you another loan for an owner occupied house. So I started really thinking about, okay, how can I scale this? How can I double or triple or 10x? I wish I was thinking 10x at the time, but how can I double or triple the amount of properties I can buy in a single year? I started reading a ton of books, and eventually I stumbled across a book about multifamily, and everything that I wanted to accomplish, I realized that I could do by buying apartments. And, comparing an apartment building to a single family home, if the rental prices were equal, and I know that they're not exactly equal, you can usually get more rent for a single family home, but all things equal, you buy a 10-unit property, you have 10 tenants, 10 rents, 10 income streams coming in. It's almost equivalent of buying 10 single family homes, but it's not 10 times harder to do. It doesn't, there's one single transaction instead of 10 transaction. When you have 10 units, typically they're all under a single roof. And so, it's not 10 times the expenses, but you are getting about 10 times the income. So it made sense to me. It's like, okay, if I can just figure out how to buy, a 5-plex or an 8-plex or a 10-plex, that's what I'm going to do. All right. And so I started doing a lot of, research on how to buy the small multifamily. And, the next step in in my progress, okay, we're gonna sell a couple of our single family homes, tap into that equity that we have, and we'll use that to buy, a 5-plex or an 8-plex. And along the lines, I started calling brokers, and I started touring a lot of these properties. And I remember walking out of one of them, and it's a couple miles from where I'm sitting right now. I remember walking out of one of them thinking, gosh, I don't even know if this is going to be a good deal. How do I even know if it's going to cash flow? And I realized that, I had this idea of apartments, but I didn't know how the mechanics worked. I was at the time planning on just taking a leap of faith, buying something and figuring it out. It kind of worked for me with single family, but I didn't want to, put, 300, 400,000. That's about what I was able to get from the sale of the homes. 300,000, I think. But I didn't want to put all that at risk, not knowing what was going on. So, long story short, I started looking at more education, instead of just the podcast that I was listening to, how can I get more education? And I joined a coaching program. It cost a pretty penny to do, but, I filled in the gap that I had. I figured out how to analyze the properties. And something else that was really nice is I was around other people who were doing what I want to do, right? Or what I wanted to do at the time. And I think the combination of the education and being around other people really helped me to get my start. And I was introduced to this idea of syndication. Instead of being limited to how much money I could bring to the table, I could tap into this thing called OPM, other people's money, and be able to, now, I mean, it's not, there has to be a value proposition. I have to be adding value to people for them to be able to want to invest with me. But I started realizing that, man, 5 units and 8 units, man, that seems so teeny tiny, and it really helped me to start thinking bigger. Being around other people who were closing on larger properties got me realizing that I could close on larger properties. So 2019, just over 3 years ago, we closed on 3 properties in 2019, a 16 unit, a 39 unit, and a 33 unit. 2020, we closed on 5. There was an 80 unit, a 40 unit, a 20, I don't even remember, 28 unit. We sold that one a while ago. An 82 unit, and which one am I missing? 167. 2021, we only closed on 2, 144 unit and a 26 unit. And, this year, let's see, it's Wednesday today. In 2 days, if all the paperwork gets through, we'll close on a 61 unit. And then I was also involved in, this one wasn't one that I found, but I did get a small piece of a much larger property, a 372 unit property in Houston. So, I provided a very, very small role in that one, but very strategic as well. So, if you look at some of the other properties, I own a much larger piece of the pie of some of the ones with smaller unit counts, like the 26 unit. I think I'm the single largest owner at 20%. The 372 unit, I think I own less than 1%, but that sliver of less than 1% on a gigantic property is actually worth more than a lot of the other ones. But long story short, that's where I am right now. Something else that I would like to mention, before joining the Marine Corps, I wanted to teach, and it's always been a passion of mine. And part of what I do is I talk to people who want to invest. And, what I was supposed to do for the group that I was with was, find people who want to invest passively, find people who want to, a small sliver of ownership in these large properties, and, explain to them, all the benefits of investing in multifamily, and especially doing it passively. But what I found is I enjoyed the conversations a lot more with the people who are asking me, how do I do what you're doing? Okay. And so I started taking these calls. And like I said, I enjoyed them more than talking with the people who were like, yep, I've got $50,000, $100,000. I'm just looking for a place to put it, tough problem to have. But, so what I started doing is, I started hearing the same questions over and over again. And I started writing down answers. Like somebody would ask me a question and I would shoot from the hip, it'd be like, oh yeah, good question. I'd give him my thoughts and then I'd sit down later, man, I should have told him this. I should have told her that. I should have told her whatever. And I would just start writing things down. I start typing just like, this is what I should have. And I started organizing my thoughts and I turned it into blog articles. And, that was kind of part of the genesis of the podcast. But what that eventually turned into is, this big gaudy logo on my left shoulder. But, the Tribe of Titans, which is an educational community, so, for people who want to invest passively in real estate, I can definitely help them. If you're one of the people that has the problem of, a big chunk of change, sitting that you need to put to work, but you don't have enough time to get into it, I can definitely help with that. On the opposite end of the spectrum, if you're the type that, wants to learn to do what I'm doing, I've put a lot of work into, crafting. I think they're well-written articles, but, I might be biased. I wrote them. So, but yeah, so that's, in a nutshell where we're at right now. And, what that looks like. I got a text earlier today. Let me see if I can find it. All right. Let's kind of share my screen. Oh, host disabled screen sharing.
Hang on for
Okay.
Yeah, hang on. And really quick, Brian, you used the word syndication early on. Just in case people aren't aware of that word, could you give us a brief definition of what that is?
Yeah, a syndication is essentially you pool people's resources together to do something big. I mean, that is the general definition of a syndication. So essentially, we find a large property. And here, let me show you this first. So this came from one of my partners. Transfer date October 27th. So that's tomorrow. You guys see that amount right there? That's what's hitting my checking account tomorrow. All right. So 43,000, if you can't see it, $43,837.99. Okay. Hitting my checking account tomorrow because we sold one of these properties. Right. But, anyway, back to what a syndication is. And that property was a syndication. And, I'll explain what a syndication is with this one specific property. We found this 80-unit property. Purchase price was $2.4 million. All right. And we got a really, really good price for it. It was kind of in a really small town in South Carolina, but close to, a lot of the bigger cities in the area. So we bought it at a really, really good price. Like I said, it was an 80 unit. There were 8 down units, like ripped to the studs down units. And so we put about $150,000 into it. Now, 240 unit or $2.4 million property. We had about a $700,000 renovation budget, all in at 3.1. We went to a lender and said, hey, Miss Lender or Mr. Lender, what can you guys give me? And they came back and said 1.9 million. We'll give you a $1.9 million loan on that property. And so we're like, okay, 1.2 million. That's what we need to do. So basically we just started calling people, everybody that I knew that was interested. And by this time, I mean, I had talked to dozens, if probably hundreds of people who had interest in investing in apartments. And, we sent emails out. We just started talking to people. Hey, here's the deal we have. It's this property in South Carolina. We're buying at 2.4. We already have an appraisal at 2.8. So there's already a lot of equity into it. And we brought in $1.2 million worth of investor capital, 50,000 here, 50,000 there, maybe one larger investor with 100 or 150. But for the most part, in $50,000 chunks, we got to 1.2 million. All right. And the way we set that up is we carved out some ownership for people who contributed capital only. And for the people who were doing all of the work, we kept a little percentage of the property. So My partners and I ended up with 25% ownership of that property for bringing the deal, to the table, getting it under contract, all the work we had to do, and finding the investors, and then doing the renovations, operating the property. 2.5 years is how long we owned the property, and we just sold it at 4.8. So our all-in price was 3.1, and we sold it 2 days ago at 4.8. And that check right there was, my portion of it for this much money in. I put $0 into that property. I wish I would have put money into it. But that was our fourth syndication. And I put some money in syndication number 1, and then syndication number 2, and then syndication number 3. And by the time we got to number 4, I was out of schlitz. I'm just like, I don't have any money. I don't have any more right now. But so that's essentially what a syndication is. You get you pool a bunch of people's resources together. You go do something a lot larger. In this case, we pool people's money. And then a small amount of people, use their time and resources to be able to operate the property. And end of the day, everybody made a pretty good chunk of change. Our investors, just to make numbers easy, somebody who invested 100,000 with us, tomorrow will have about $155,000 deposited in their bank account in 2 years. So that's the power of a syndication. I make money for doing a lot of the work, and the investors make money for contributing capital.
If somebody was here that, they're interested in making a syndication, is there a general way to structure a syndication? I mean, I know every deal is different, and, but yeah, could you speak on that?
Yeah, there's lots of ways to do it, and you can basically get as creative as you want. But in general, you're going to split the ownership into a general partnership and a limited partnership. Okay, the general partners, it doesn't matter if you remember the terms, but you have people who are doing the work and people who are only contributing money. Okay, the general partners are doing the work, the limited partners are contributing the capital. But right now, I would say for the most part, the limited partnership are going to walk away with about 75% ownership, and the general partners are going to walk away with about 25% ownership. Okay. And now when we talk about the ownership, that's after everything's paid out, right? So when we sell it, we pay off the debt first, we give people their money back second, and then everything on top of that goes 75-25. So all the profits are split 75-25 after we give people their money back, right? So that's probably the simplest way to set something up, is just with a straight split. And a lot of people will just say like, hey, it's a 75-25 split, or it's an 80-20 split. And that just means that the passive investors are getting 80% of the profits, if it's an 80-20, and the people who are doing the work, they're going to earn 20% of the profits through all the work that they do.
Is there, so you mentioned, 80-20 or 70, whatever the split is, that's only at the end when you guys exit, whether it's selling or refinancing. What happens in the meantime?
Yeah. In the meantime, we do distributions. Obviously, there are people who live there that are paying rents. We have expenses. We pay the mortgage. Basically, all of the profits is the answer to that question. So all of the profits get distributed 80-20. Now, once again, you can get very creative with this one. What most people do is they will give you your original money back when they either sell or refinance. Okay. But once again, there's lots of different ways to structure it. I would say the most common way is, as the property is producing income, that is viewed as profit. And so 80% of the income off of the property, or the profits coming off the property, go to the investors, and then 20% go to the people who are operating the property. So basically profits, all profits, no matter how they come in.
Oh, okay. All right.
Yeah.
Now, if I were somebody who wanted to invest in a syndication, what are some things, because you've been on both ends, right? You've been the syndicator and you've been the person to a limited partner, right?
Yep.
So as a limited partner, what are some things that you should, look out for when you're vetting a syndicator, or when you're looking for a deal to invest in?
I think the three things: know, like, and trust. It's got to be somebody that I wouldn't suggest, just Googling, hey, invest in multifamily and picking the first link. Find somebody that like, and trust. And with that trust aspect, I would just say they have to have experience. They have to have a reputation, and a solid reputation, so not like the Fresh Prince, that girl's got a rep type thing. But sorry, guys, I was, born and raised in the 80s. So if you guys didn't get that, it's from a Will Smith song back in like 82. But yeah, so yeah, I would say you got to make sure that the sponsor has the capability of running the deal. And there's a lot of people who are brand new trying to get their start in this business. Unless you have a really strong personal relationship and you really want to help them out, I would prefer personally to put my money with people who have been there and done that before, right? So look for, like I said, know, like, and trust somebody who has experience doing what they are showing you. So if they're showing you, hey, we're going to do, a 500 unit property, we have like an $8 million renovation budget, and this is what we're going to do. Ask them, have you ever done that before? Or what's the closest thing to that you've ever done? If they're trying to tackle a 500 unit and the biggest thing they've done is a fiveplex, you probably walk away, right? Just like, hey, maybe on the next one. But yeah, just make sure they have experience, make sure they're going to be able to deliver is the answer.
Okay. Before, or when people were coming on, or when they registered, people threw up some questions. So I wanted to get to some of those before we run out of time and into our next segment.
Okay. Yep.
And the first question that came in was, if they're brand new, right? They're just wanting to start in multifamily. What would be a strategy that you would suggest for somebody brand new trying to get into the space?
It depends on, I think there's two legitimate routes. There's as many legitimate routes as you can get creative, but I would say the two most common routes is like a slow grow, where you buy a fourplex. Okay. For most people, buying a fourplex is accessible. All right. You can do a live-in house hack on a fourplex. All right. But you buy a fourplex and then, live in it for a while, house hack, save up your money, and then you get into an eightplex. And then you gradually get larger and larger properties. Okay. A lot of people do that. I have a pretty good friend named Paul, lives in Indianapolis. He's got about 100 units, and that's all him. That's what he did. He started with a fourplex. Actually, I think he started with a duplex, but regardless, that was just a organic growth. And he had like 5 or 8 properties, sold them all, bought a 40plex, and then bought another 40plex, right? So that's one way to do it. And that's kind of the organic growth, the way to slowly build a portfolio. If you're looking to syndicate, it's a little more complicated, to buy something that's like a 50 unit or 100 unit. Okay. We probably have a bunch of realtors in here. I see, at least one person that has, home buyers in the background, but when kind of there's a barrier to, let me, instead of giving an example, I know we got probably a lot of questions. The short answer is find a team. Okay. It takes a team to get these, 50 to 100 units. Find a team and, kind of divide and conquer all of the work. And somebody on that team is going to have experience is the answer. So really the answer is find a team, figure out how to get educated, then find a team, and then start looking for deals is the answer. And, I talk about all of that in my Tribe of Titans as well. So we can break that down in as much detail as anybody wants.
Got it. So you mentioned finding the deal. With the deals that you're operating or investing in, how are you finding these deals? Are they on market? Are they part of your network?
Yeah. So most commercial multifamily deals, there's not like I guess technically you could put it like on the MLS, but there's not like an MLS for commercial real estate. Okay. Most of these are brokered deals through a commercial real estate broker. Okay. And when we talk about a marketed deal, it's, when a broker gets a listing, they'll email it out to their distribution list. Okay. That's a marketed deal. It's not quite the same as, MLS on market, but that's the equivalent. But really it's just a matter of building relationships with brokers and proving to the brokers that you can close. And if you can do that, they're going to start ideally sending you the off-market deals, and sometimes those are referred to as the pocket listings. And that's basically, I've got a property to sell. I call my broker and say, hey, Mr. Broker, I'm looking to sell that 120 unit. Yep, that one. Yep, exactly. And, the broker is going to hang up the phone with me and just sit down and think, okay, who's the person that's most likely to buy that really quickly with one phone call? And they're going to pick up the phone. They're going to call that one person. Hey, I got this 120 unit that, somebody's talking to me about selling right now. Are you interested? Those are the off market deals. That's the true off market deal. So really it's a matter of, it's a matter of getting to know the brokers. And for the first, I think I've been involved in 12 transactions right now. For the first 8 transactions, they were all straight from brokers. The last 4 that I've been involved in have been from me knowing the sponsors, and I figured out that for me, it's a lot easier to get to know sponsors who have good relationships with brokers instead of trying to keep the good relationships with the brokers. What I've been doing recently is I've been the guy that plugs capital into other people's deals. And so I would rather look over 3 deals that, my people in my network already have under contract than 100 deals to find 1 deal to get under contract. Okay. Because like I said, what I do and what I bring to the table is I look at the people in my network. I find people who want to invest $50,000 chunks. I get $1 million together and I plug it into somebody else's deal. And so right now I'm focusing more on getting to know the people that are buying and that need an infusion of cash. And so in a way, I'm a money broker. Don't tell the SEC I use that word because there are broker dealer laws and I'm not technically a money broker, but I have to make sure that I'm not a money broker is the answer to that question. But so yeah, that's really what I'm doing right now. I think 95% of all multifamily transactions in the last couple of years have been through a commercial real estate broker. But like I said, I'm dealing with the sponsors, people that I know, like, and trust, people that I want to put my money with. And then when I find one of those, I invite my friends to invest with me.
And really quick, you said sponsor. Is that a whole different role, or is that
the
GP, or what is that?
So when I say sponsor, I'm talking about the person who's putting the deal together. That's what I mean by that. So the deal sponsor is the person who's overall responsible for making sure everything works on that deal. And there's partnerships of all different shapes and sizes, and even some of the. So I'm getting warm in here. I got my little space heater on, and it's warmed up a little bit. But even some of these companies that have existed for a long time that have thousands of units. I'm talking with a guy tomorrow about a deal in Dallas. His company owns 5,000 units, and they still need help raising capital, right? And so, yeah, the lead sponsor in this deal, they go find a property and they start looking at it and say, this is what we can do. This is what our capability is to syndicate or bring capital to the table. And hey, it looks like we're going to need 2 or 3 other people to bring in $1 million each. And they start reaching out to people like me who can do that. And so, so the lead sponsor, the person that's overall in charge of running the show.
And that's separate from the GP, right?
That's part of the GP. I mean, they are part of the GP, and the people that they bring in to complete the team, that team is the general partnership.
Oh,
Okay.
okay,
So,
got it.
so when they invite me in and they say, hey, Brian, we got this peach of a deal in Dallas, I guess, we got this really, really good deal in Dallas, and we just need a little bit more money. They typically are bringing people like me into that general partnership. And, I've got a role in the company. I've got responsibilities with the company. I bring capital to the deal. And now I get paid by having a piece of that general partnership. So I will have maybe, 5 or 10 or 20% of the general partnership. And then if I invest money on the side as well, I'll make money from my investment, and I make money from, my GP percentage as well. So I can usually do pretty well, investing my own money and getting a GP share.
Okay. All right. Thanks for clarifying that.
Yep.
This is a fun question. So what was your most challenging moment in multifamily investing?
Ooh, deciding to leave a team that I had been with for 3 years. That's probably my most challenging thing. And it doesn't have a lot to do with multifamily, but I guess it does. I mean, multifamily is a team sport. I've been with this group for quite a while. 9 properties, 655 units, I think is what we did together. But things weren't going the direction I wanted them to go, and yeah, I had to make the decision to leave is the answer. So that was probably the toughest thing that I did personally. Probably not what people were looking for when they asked the question, but that was it.
Yeah, no, I think that's a part that people overlook pretty often.
Mhm.
So
Yeah. Make sure you have alignment is really what it is. When you're picking your teammates, make sure you're aligned and your alignment goes deep. And I think what happened with this team is we were aligned up front, and our alignment was essentially, we all wanted to buy our first multifamily property. And so we came together, and then the second one came on the heels of the first, and we bought a lot in a row, right in rapid succession. And, we started realizing very slowly that we didn't really have really good alignment. And that's came a point to where I realized I had to leave, so yeah, so that's it.
Yeah. So earlier you were mentioning like you typically work with people that do $50,000 chunks in investing. Is that the minimum that you typically require for a deal that you put together?
Most deals, yes. Occasionally we can do the smaller deals. We can bring in smaller chunks. Like the 20, about a year ago, I closed on a 26 unit that was a syndication. We only had to raise 600,000. So on that one, we were happy to bring in, lower dollar amounts, but, if we're raising, several $1 million, the more money we have to raise, the higher we set the bar. If we try to get $1 million in $10,000 increments, that's a lot of freaking people. But even in $50,000 increments, that's 20 people. I got to find 20 people with $50,000 to invest to hit $1 million. So in general, 50K is our minimum. On some of the larger deals, 75 or 100K are common minimums as well.
Depending on how much they invest, does that determine or change or affect their return?
It can. A lot of people, what they will do is they'll have different tiers in their investment, and it just kind of attracts a lot of different people. Some people are looking for more cash flow. Some people are looking for more growth, so what some sponsors will do is say, if you invest at least this much, we can kind of tailor your returns to whatever you want. Or they'll have different, they call them classes of shares, where if you buy, class A of shares, you're going to get 12% on your money, no more, no less. But you get paid before everybody else does, so you have a much higher chance at getting 12% than everybody else because you get paid first. Everybody else in the group, they're sitting at that 80-20 split. If things go well, they're going to get a lot more than 12%. All right. But if things go poorly, a lot less than 12%. Right. So sometimes, larger dollar amounts, you can get better returns. Most of the large deals that I've seen, I'm talking, 20 million plus, most of these larger deals where sponsors are raising, I say like 8 million, 10 million and above, you're going to see a different class of shares for people who are investing, $500,000 or $250,000. And they're going to give slightly higher proceeds to the people who can bring more money to the table. And the idea is if I've got one really wealthy person, I want him to write a big check. I want to do everything I can to make sure that person writes a big check. So you will see that. And sometimes we can take advantage of that. One kind of a similar topic. One way to take advantage of that is I've set up a fund, and a lot of these deals that have these higher tiers, I can put lots of investors into the fund, and then the fund can invest into a deal and get one of these higher tiers as well. So there's lots of different ways to take advantage of that. So if there's a deal that has this $500,000 tier, and you get better returns once you hit that $500,000 tier, that's where I pull my fund off the shelf and say, all right, guys, let's everybody put in 50,000 into this fund, and we're going to invest in this deal. And instead of getting, a 15% annualized return like everybody else, we're going to get 18, right? So there are ways to take advantage of that.
Okay. Now, I didn't realize we're already coming up at 6:46, and we have another segment, but we have a bunch more questions that actually you guys submitted early on, and if we could do maybe one question, Brian, if we can
I need to give short answers is what I need to do. How about that? Yeah, I'll just shorten my answers down.
Let's see if we can. I see some in the chat. So can you explain the difference between an accredited and non-accredited investor?
Yes. Accredited investors, there's several criteria. The most common criteria to be an accredited investor is annual income of $200,000 or more over a couple of years per person, or a net worth of $1 million. And what this gives you is access to more deals. Okay. If you're not an accredited investor, you have to know somebody to get in. So simple.
And you have to have that status or you have to have that net worth for a certain length of time, correct?
There's no timing on the net worth. There is timing on the income. So if you're an accredited investor by income, you have to have made $200,000 or more for the last 2 years, and a reasonable expectation to make the same amount in the current year. So 3 straight years, essentially, including the year that you're in.
Okay. All right. And then Jeff asks, what is a normal minimum time for syndication? 1 year, 2 years?
It depends on the deal. Every deal is, I would say most common is 2 to 5 years. If people are doing value adds, a lot of sponsors just want to get in, fix things up, turn it around, and they're essentially flipping the property. But to do a complete flip with multifamily usually takes 12 to 24 months. So shortest, I would say 12 months, but some people who are trying to get cash flow will do syndications that last 10 or 20 years.
Oh, okay. All right. Now, Ellard says, you mentioned that everyone splits all the profits. Yeah. So what happens if things don't work out as planned?
It depends on how the deal is set up. Okay. So the general partners, if there's a small loss, it depends on how things are set up is the answer. But ideally, yes. But if the deal goes south, people are going to lose money. The general partners are also exposed to litigation. The limited partners aren't. So everybody is going to lose in that case. Depending on how things go, some might lose more than others, but it really depends on how the deal is set up.
Yeah, that makes sense. Okay.
Yep.
Okay. And then,
one step further. If we're doing an 80-20 split on ownership, who can lose money? The people who put in money can lose money. All right. The GP puts in time, and so, if things aren't written properly, the LPs can take the brunt of the loss. All right. So back to your first question, about sponsors, I would look for deals where sponsors are putting their own money in that way guarantees that they're taking part of the losses if you are too. So anyway, I'll go short on every other question.
Right. Yeah. And really quickly, you know, I don't do syndications, but I do work with private individuals. And that's how I would approach it as well. Right. They get paid out first. I'll lose my shirt before they lose their capital. Right. I'm willing to do that. So, okay.
Yep. And you got to make sure you have a sponsor that does. So, yeah.
Cool.
Saw a question from Zasha. Do you collect funds prior to finding a deal or after you find one? After we find one is the most common. Although my fund does allow me to collect money before we find a deal, I typically don't. I typically wait till I have a deal in front of me. And so I can pitch a certain deal to everybody. Hey, you know, this Dallas deal is awesome. You're going to love it. Or, hey, this Houston deal or Atlanta deal. And we can talk about the numbers and the deal itself. But in general, we have a deal under contract. We're done with due diligence on our part. And now we're bringing investors in.
All right. Now, I think that was everything in the chat. And I'm sure more people have questions that they want to ask, but we want to honor everybody's time. And Gilbert, did you have anything that you wanted to ask or any last comments before we transition into our next segment?
Sure. No, thanks for that, Brian. That was a really good presentation and, you know, going over syndications and whatnot. But, you know, I'd like to just ask everyone in the group to, you know, give Brian a follow. If you guys got more questions, you know, we'll put his contacts in the chat here. I'd also like to ask everyone here to give us a follow on our Facebook page as well as our YouTube page. And, you know, just give us a shout out to everybody out there. Share what Westside Meetup is about. Right now, I'd like to transition over into something new that we've been doing. So we've been highlighting investors in our community here. And tonight we have Tahnee Dela Calzada. Welcome, Tahnee.
What's up, Gilbert? Thanks, Gilbert, Brandon, for having me. You want me to just go with it, Gil? Do a little bit about myself. Okay. Hi, everyone. My name is Tahnee. You can find me on Instagram at shinebright_real-estate. I am an out-of-state long-term investor. I concentrate on cash flow. I'm still stuck to my W-2 job. So I'm in the military, been with the Army National Guard for 14 years and working my way towards financial freedom. So I'm also a WNN advisor. I'm helping the founders, CJ and Jasmine, start their commercial real estate mentorship, helping investors pretty much learn how to invest in commercial real estate in Kansas City, Missouri. For myself, I started seriously investing in Kansas City about early last year. I read the Burr book, I read, the investor books, and I really wanted to get into real estate. I just didn't know how. And I saw a friend, he's on here right now, Blaze. So we're actually friends from elementary school, but with Facebook and keeping on contact with social media, I saw what he was investing in. And he told me about the mentorship he was a part of. And I took that chance, right? The books give guidance and tell you, find a mentorship, find other people who are doing what you're doing, and learn from other people's mistakes. And that pretty much was my buy-in to WNN Properties. I started in the residential mentorship. So prior to that, I already had one rental here in Hawaii, and I guess you could call it the accidental investor. So I bought a house, life happened, we rented it out. I bought another house, I house hacked, bought it off market, under market value, just doing the things that investors were doing, but I didn't know was the right things to do. I was just taking action. In the beginning, my strategy was to buy one property every 3 years. Similar to Brian, moving around every 3 years. That was my strategy to using the VA. And once I got with WNN, I catapulted my real estate strategy. So I took that first rental, analyzing my portfolio with my mentors and looking at what I had, and having a home in Hawaii with appreciation going up, my rental income was breaking even. I think actually like negative $40, but being with the right team, they gave me the confidence and the mentoring that I needed to catapult myself into Kansas City commercial real estate. And right now I own a commercial building and in the stabilization phase with that property. It's fully occupied. Just stacking up my cash so I can slowly escape my W-2 job. And I've been working with other WNN advisors and mentors to close on more commercial deals. So being a part of the team, our commercial broker sends us deals daily, and just getting into that practice of analyzing deals, putting in offers. I'm in the accumulation phase as far as, trying to build that portfolio. And whether that be a partnership or by myself with my husband, just trying to find the right partners and, taking action daily, analyzing those properties to build that portfolio. So that's a little bit about me. You want me to share more, Gil?
All right, on. Thanks for sharing who you are, what you do, and where you're going in real estate. Really, really awesome journey you have here, and excited to see what you're gonna do next.
Can I
Now
add
I'd
one?
like to transition. Go
One
ahead.
more.
Go ahead.
So also being a part of WNN, I host along with my team of other advisors for real estate event. We just held our last quarter for the last quarter event. I think it was about 2 weeks ago, October 19th. Could have been last week, Wednesday.
Last week.
Last week.
Last week, Wednesday. Sorry, my time goes by fast. And then so we're hosting our next one in January. So I'm also a part of creating events where like-minded individuals, just like everyone on here, but we get to meet in person, drink some cocktails, network, and listen to experienced investors share their story and give advice. So if
Awesome.
interested in that, keep an eye out. I'm sure you'll see it on social media.
Thank you, Tahnee. Thanks for sharing.
Thanks for
I'd
having me.
like to bring up our other co-host of Westside Meetup here, Rod. To you got anything to add, Rod?
Yeah. Thank you, Tahnee, for sharing all that information. Everybody go check her out. I'd like to thank Brian. Hey Brian, I want to thank you. I noticed that you served the military, so I want to thank you for your service. That was awesome. I like
Thank
that you shared the slow grow. That was pretty
Mhm.
cool, for everybody, for all the new investors. So I'm a WNN alumni. I just finished my mentorship, so something that stood out to me was the slow growth. So
Mhm.
buy one, slow, buy one, and grow and stuff like that. So
Yeah.
that was awesome to know. And then you talked about the the Titan 2 tribes.
Mhm.
Would
Yep.
you like to talk more about that and share a little bit more information about that?
Yeah, I think so. What Tribe of Titans is, I call it an educational community. We have a lot of educational resources in there, and there's just a lot of really, really good people. There's about 200 people that are in the group. There is a small subscription fee to keep the lights on. I don't make a ton of money off of it, but basically 200 people who are all multifamily investors. I would say about 80% of them are looking for their first deal. 20% have already done, something, a little more significant in the space. But yeah, we have educational resources on a weekly basis. We have a weekly underwriting call. There is a course on raising capital. There's a course on analyzing deals that's almost done, almost ready to hit prime time. And just a lot of content for people who are new to multifamily. What's the difference between multifamily and single family and things like that. So like I said, it's an educational community, lots of events. Tomorrow we're going to have somebody come talk to the tribe about setting up a fund, probably a little more advanced concept if you don't understand syndications, but twice a month we bring in experts to talk about various aspects as well. And then we have a weekly networking event that typically draws 40 to 50 people.
Awesome. Thank you for sharing that,
Yeah.
Brian. If anybody wants to follow Brian or ask Brian more questions, his emails and his information is in the chat. as well as Tahnee. Her information is in the chat. So go look them up, follow, ask questions. And before we go to the next segment, yeah, we're everybody stick around. We have a outbreak room. That's where we can do some networking and stuff like that. So stick around for that.
Hey Rod, in the breakout rooms, what should we be discussing, and how long are we going to do it for? 25
do it.
minutes?
25 minutes is good. And then what we can discuss about is how are you guys going to end the year strong, and what is your goals?
Cool.
Right.
So how are you going to end the year strong, and what are your goals? Awesome. Right
Going
on.